Differences between VAT and withholding tax. VAT versus withholding tax. Value-added tax, VAT, is an indirect tax applied at each stage of the supply chain, from production to the point of sale. Businesses collect VAT on behalf of the government, however, the final consumer ultimately pays the cost. Whereas, withholding tax, what, is a direct tax. It applies when Saudi-based entities make payments to non-resident parties for services or rights used within the kingdom. Since these foreign entities often lack a physical presence in Saudi Arabia, withholding tax ensures they contribute to the local tax base. The purpose of VAT is to tax final consumer and raise government revenue. Whereas, the purpose of withholding tax is to improve income tax collection efficiency. VAT is an indirect tax. Whereas, withholding tax is a direct tax. The standard VAT rate is 15%. Whereas, common withholding tax rates are 5%, 15%, and 20%, depending on the services. VAT is used for goods and services sold within the Kingdom of Saudi Arabia, KSA, whereas, withholding tax is used for payments to non-resident entities. Final consumer pays the VAT. Whereas, foreign party pays the withholding tax that is tax deducted by Saudi business. Filing and payment are done on monthly or quarterly via VAT return, whereas, filing and payment of withholding tax payments are done when it becomes due immediately upon payment. Input VAT is recoverable whereas, withholding tax is not recoverable. Tax treaty relevance is not applicable for VAT. Whereas, tax treaty relevance may be reduced or exempt under treaty terms for withholding tax. As a result, VAT supports government revenue without directly taxing income. Additionally, it encourages better record keeping and transparency throughout the business process. Whereas, proper record keeping and documentation are essential for both VAT and withholding tax to support any tax filings or audits. In short, VAT is used for targets consumption, collected at every stage of production and distribution and split payment responsibility along supply chain. VAT applies to domestic sales, imports, and certain services. Businesses must register for VAT if their annual revenue exceeds Saudi Riyal 3,75,000. VAT returns must be submitted monthly or quarterly via the Zatka portal. Eligible input VAT can be reclaimed, thereby reducing the overall tax. Whereas, withholding tax is used for targets income, collected at source of payment and full payment responsibility lies with payer. Withholding tax applies only to cross-border payments made to non-residents. The Saudi payer must deduct and remit the tax directly to Zatka. Withholding tax must be paid immediately after making the payment. Double tax treaties may reduce or eliminate withholding tax. Kindly subscribe my YouTube channel Thesis Helper. Thanks for watching.